we know that the Australian property market has started its next growth phase based on, number one, a massive undersupply of houses. The National Housing Finance and Investment Corporation reports that there's going to be a shortage of 106,000 properties by 2027. Number two, buyer inquiry is on the increase. Agents are reporting attendance rate at open for inspections and auctions being higher than ever. And number three, land developers increasing prices of land to cater for that demand. So the question no longer is now the time to buy? The answer is clearly a yes, if you can afford to. The question now becomes, where is the best place for you to invest to take advantage of this next growth phase? And that's exactly what we're going to cover today. Hi, it's Nero here, and if you're someone who wants to invest in property, but you're someone who is a bit of a low-risk investor, then I've got some good news for you. Let's have a look at this. An article from the Australian Financial Review talks about this area of the housing market is set to outperform. The upper end of the housing market is leading the recovery from the downturn, but more affordable areas have performed better in the long run and are poised to outperform in the next cycle as affordability weighs on buyers' budgets, new data shows. So the question then is, what does affordable mean? What sort of price points should we be looking at? Well, let's keep going. High income earning areas are currently winning due to the fact that these markets were the first to fall and look like the first to recover, and stock is also limited in this segment relative to buyers, said Kent Lardner, founder of Suburb Trends. Next cycle will likely have similarities to this one. However, affordability is rapidly changing the dynamics in such a way that markets are displaying different characteristics. And here's the good news. One example is the limited number of listings and lower price falls are expected at the lower end as more buyers are pushed out of the higher tiers and down into the $750,000 and under markets. As such, I expect markets below $750,000 to stay strong. Now, if you've been following my work for any length of time, you know that I've been saying that it's the lower end of the market that has shown the most price growth in the last 12 months. Okay, we're seeing areas right now where properties are coming on the market on Tuesday and they're selling before the weekend. Recently, we found a property that was very suitable for a client of ours. The price being requested was $470,000. It came online on Tuesday. On Wednesday, I presented it to my client because it met what we were trying to do. On Thursday, 2 days after the property was listed, I tried to negotiate the deal and the agent told me to go away because in just those 2 days, the agent had received 8 offers, several of them well above the asking price. And she didn't want to talk to me. She was happy with the offers that she had got and the property that went under contract. Similarly, we found another property where I was able to negotiate a deal only because I was dealing directly with the vendor. We got the property for $489,000. The rental appraisal at the time was $500 a week, a pretty good return. But the property then got rented 3 days after it settled. Purchase price, remember, was $489,000. It ended up renting for $520 a week. And that's what we're seeing in these lower priced markets where prices are below $750,000. There's massive demand from owner-occupiers driving prices up because of the shortage of stock, but there's also massive pressure on rents, which is giving property investors really, really strong yields as well. Now, this article then goes on to talk about which areas have fallen the most, and it talks about how many of the higher price areas have fallen the most in the last 12 months. But now have a look at this. By contrast, the low income areas such as Adelaide and Onkaparinga in South Australia posted 10% and 17% price increases during the same period, respectively. We're talking about the last 12 months here. A separate analysis by Jeremy Shepherd showed a similar trend where the most affordable housing markets climbed by about 25% in the past 12 months, compared with about a 10% drop in the upper end. A lot of the buying pressure has moved to the cheaper end of the market since the start of interest rate rises, Mr. Shepherd said. With higher prices, more and more buyers are priced out of the market unless they target cheaper areas, hence the flight to affordable markets. On top of this, the higher interest rates have forced buyers to aim lower. And not only are we seeing this in the media, I'm seeing this with the results my clients have achieved in the last 12 months. One of my clients bought a property in September for $483,000. In April, they got a bank valuation, $550,000. If you do the numbers on that, the annual return is going to be in the order of 20% plus. Another client bought a property in January of this year for $315,000. 2 months later, the bank valued it at $20,000 higher. Okay, it has been the lower end of town, the properties priced in areas below $750,000 that have really shown the strongest performance. So if you are an investor who's low risk, you're looking for something to just get started with that's affordable for you, where you're also going to get good capital growth and strong rental returns, the data is clearly showing that looking at areas below $750,000 is where you want to look at. Now, of course, that doesn't mean that you go and buy a property in the sticks somewhere for $150,000, because that could really hurt you. You want to be looking at areas that have multiple industries feeding them, they have good job opportunities, and there are people moving into these areas. And look, there are multiple areas that fit this brief. I mean, check out this study here, which was commissioned by the Regional Australia Institute. According to the study, 1 in 5 metropolitan Aussies are considering the move to regional Australia as a solution to rampant inflation, traffic congestion, and stress that comes with city life. The pandemic has caused a shift in migration patterns, with regional Australia experiencing a growth of 70,000 people in 2020 to 2021. This trend is set to continue, with regional migration up 16% on pre-pandemic levels in 2023. Despite a small uptick of regional Australians returning to the cities, the study found that many Aussies are still drawn to regional areas for their sense of space, affordability, and improved well-being. But it's not just a desire for a better quality of life that's driving this trend. The study also revealed shifting attitudes towards regional job opportunities, with over a third of respondents viewing salary prospects in the regions on par with major capital cities. And that's why large regional centres will continue to do well. But not just the regional centres, capital cities will do well, but especially the smaller capital cities where prices are lower. You saw, for example, the data just earlier about how well Adelaide has been doing. Well, here's what CoreLogic's research director, Tim Lawless, had to say in a mid-month update on his LinkedIn profile in May. A mid-month update on the trend in housing values based on CoreLogic's daily HVI. The upswing looks to have gathered some momentum, especially in Brisbane, where the index is up 1% over the past 4 weeks. Sydney still leading the charge. Each of the majors are showing a rise in values amid low supply and rising demand. So we're starting to see price increases across the board. As I said, large regional areas are doing well, smaller capital cities are doing well, but certainly pockets of Sydney are doing well as well. But that's a totally different criteria. As I said earlier, property prices at $750,000 and below are doing really well. You don't get much for $750,000 in Sydney, especially when you're looking at houses. So therefore, what's driving Sydney house prices to rise? It's the upper end. It's property prices at around about $1.8 million and above. They are the ones rising in value. They are the ones pulling up Sydney's property prices, because again, for the number of buyers who can afford that particular price point, there aren't enough properties for them. So whichever way you look at it, whether you are a big spender and you want to go and spend a lot of money, then it is the higher end of town that's doing well. But if you're a low risk investor, you're looking for safe, secure investing, better yields, then get excited, because now is the time to really jump in if you can afford to. I've been saying this for a while. 2023 is a great buying opportunity, and we're now starting to see even the media catch on. We're talking about properties in areas for below $750,000 with strong population growth, multiple industries feeding them, low vacancy rates, really low risk investing, set and forget type investing that's going to really work for you, help you set up yourself for your future while allowing you to sleep at night. And if you want help finding these great areas and finding high performing properties, then click the link in the description to get a copy of my book, the audio version and the digital version, totally for free. Or there'll be another link where you can book a no obligation call where you can find out more about our buyer's agency services if you're looking to find those sorts of investment properties. Either way, I think we have a great opportunity in front of us. If you can afford to, I really hope you'll take advantage of it. I'll see you next time.